Okay, good afternoon, ladies and gentlemen. Thank you for joining us today at this webinar. So if you're here yesterday for our previous webinar on Asia equity, you'll know that this is actually our second part of this two-part series webinar called We Know Asia by Nikko Asset Management. So for today, we'll focus on Asian fixed income. We'll start off with a panel discussion first amongst the four speakers that we have today from Nikko Asset Management. So first off, we have Liang Chun Ko from Nikko Asset Management. He's the head of fixed income. He leads a team of experienced analysts and portfolio managers and is responsible for managing the active Asian fixed income portfolios covering Asian local currency fixed income, Asian credits, as well as Asian currencies. So for the next speaker, we have Xiao Fang Yong, Senior Portfolio Manager of the Nikko AM Shenton Income Fund. He's responsible for managing active and passive Singapore fixed income portfolios and also contributes to the overall Asian macro strategy, with particular focus on Singapore, Thailand, and Malaysia. Next off, we have Yi-Hui Wong, who's a Senior Portfolio Manager of Nikko AM China Onshore Bond Fund. So she covers the Asian local currency bond strategy with a focus on China, and the fund she manages and co-manages includes mandates like Asia local currency bonds, RMB onshore and offshore local currency bonds, and she has 16 years of experience in the financial industry. And for our last but not least, we have Edward who's the portfolio manager of Nikko AM Shenton Asian Bond Fund. He is the portfolio manager in this strategy and specializes in Asian countries such as India, Indonesia, as well as Korea. So this fund is actually also featured on our recommended funds list on FSM1. Every year we have this recommended funds list, which really is a curation of a specified list of funds by our research team that we deem as the cream of the crop. So this fund is featured in that list in particular. So now we'll move on to the macro market overview for starters. So thank you to the team for joining us today. To kickstart the webinar we have for you today, let us now welcome Liang Chun, Head of Asian Fixed Income at Nikko Asset Management, to give us an overview of the market as he sees it now.
Thank you, Sarah, and thank you all the audience who have dialed in to join us today. Perhaps for the benefit of some of the audience that are not familiar with our team, let me start by a brief walkthrough of our team setup and also our investment capability. Our team consists of 14 investment professionals, of which 4 are portfolio managers that looks at the Asia local currency bond space. And each of these portfolio managers are assigned country coverage. For example, we have here today Edward, who looks at the Indonesia and India market coverage. We have Yi-Hui that covers China and Korea. And we also have Xiao Feng here, who looks at Singapore, Thailand, and Malaysia. Apart from that, we have another 4 portfolio managers that invest into the US dollar denominated Asia credit space. 2 of them looks at the high yield market and the other 2 covers the investment grade market. All our portfolio managers are tasked to conduct top-down research in generating macro views, which then translate into our portfolio allocation in country, credit sector, and credit quality. For example, whether we want to overweight or underweight Korea or Malaysia, and within the credit sector space, do we want to overweight or underweight industrial versus real estate? Our PM will also decide the allocation, how much to put into the investment grade versus the high yield names. These 8 portfolio managers are supported by a team of 5 credit analysts, whom are all assigned with credit sector coverage. For example, we have David, who covers the real estate space, and Nicholas, who covers the bank and non-bank financials. The team of credit analysts are tasked with bottom-up analysis through their due diligence on companies. For example, they conduct very detailed financial analysis and scenario stress testing on companies, and also taking into account ESG factors that might have an impact on the companies. But more importantly, they also conduct on-the-ground site visits, for example, visiting manufacturing plant in China or coal mining operation in Indonesia, to ensure that what's on the ground is actually consistent with what the company has presented to us. And combining all this research, they will generate what we call an internal credit rating score and credit recommendation for the team. All our team members are based in Singapore, and our clear segregation of tasks and close collaboration between our portfolio managers and analysts allows us to generate high conviction calls that goes into our portfolio. Our team currently manage 8.5 billion Sing dollar of assets, and we provide a full range of capability within the Asia fixed income space. We also have strong presence in ETF market. Our team currently runs the Singapore Government Bond ETF and also the Sing dollar investment grade corporate ETF. So now, let me go into sharing some of our market views. I think over the last 6 months or so, we have gone through quite a roller coaster ride. The spread of COVID-19 from China to the rest of the world, forcing countries to implement shutdown. We have witnessed massive sell down and flight to safety. For example, we have seen the 10-year US Treasury yield rallied from 2% in January to 0.5% by March. And most of the Asian government bond curve has also followed in tandem. Asian credit spread has widened significantly as well to levels not seen since 2011, trading around 4 standard deviation of the past 10-year average spread. The Sing credit spread also widened to 2 standard deviation to a wide of about 160 basis points, and Asian currencies have depreciated by about 5 to 8% against US dollar. That has triggered aggressive response from global central banks and the respective governments to come to the rescue with unprecedented policy response. The Fed has cut rates twice in March by 50 basis points and 100 basis points respectively to bring Fed fund rate to almost 0%. And it has also launched various facilities to support corporate bond market, commercial paper market, and also equity market through buying in ETF. The US government, as you can see on the first chart here, has announced massive fiscal stimulus package amounting to about 2.8 trillion US dollar or 12% of GDP. And the rest of the world has followed as well. Most global central banks and government has also followed with their respective monetary policy easing and also fiscal stimulus package. And the aggregate amount of all this stimulus amount to about 11 trillion US dollar, almost 3 times the amount of stimulus during the 2009 global financial crisis, which then resulted in a very sharp V-shaped recovery in the asset market. So where are the opportunities now at this moment in time? We think that Asia is the sweet spot. I think if you can look at the second chart here, both the developed market and emerging market where Asia lies in started the shutdown around about the same time in March. But however, you can see that Asian countries were more stringent in the implementation of the shutdown, and we managed to get the infection under control. And this allows the reopening of economy and the subsequent recovery of the economy. We also think that the policy rates are likely to stay lower for longer. Asian central banks with more policy cushion could continue to cut rate, thus giving support to capital appreciation opportunities to some of this Asia local bond curve. And in the short to medium term, I think the technical flow will continue to override fundamental concerns. The global seek for yield due to zero interest rate or negative rates in developed market will result in very strong technical flow into higher yielding market with stronger fundamental, again benefiting Asia currencies and the fixed income market. From the valuation standpoint, both the historical and relative valuation in Asia credit market remains attractive. Although no longer as compelling as 3 months ago, for example, Asia credit spread has tightened to 2 standard deviation from previously 4 standard deviation. On the relative basis, compared to the US and European investment grade market, Asia investment grade credit still provides healthy pickup of about 20 to 40 basis points respectively. But obviously there are some risk factor in the market. So let me go through some of this. We are concerned about the increase in geopolitical risk, particularly between US and China. And given that this year is a US election year, Trump might turn more hawkish against China as the election draws closer. Again, on the US election, the prospect of Democrats winning the election and reversing some of the dovish policy could also result in increase in market volatility. But I think to me, the biggest risk is the COVID-19 situation. We have seen a very big divergence between the asset market from the real economy. And this was mainly boosted by the market assumption of infinite government stimulus and that COVID-19 will be under control, or the availability of vaccine by end of the year. And if this assumption don't come true, or perhaps we see a second or third wave of infection that disrupt the recovery timeline, then we could see a significant pullback in asset market with increasing financial stress in companies that will lead to increasing trend of credit downgrades or defaults. And in fact, if anything, recent news after the premature reopening of some of the southwestern states in US, we have seen a new record high of infection in states like California, Florida, and Texas, which has forced them to reinstate some lockdown measures. The recent second wave in Australia, Japan, and Hong Kong are also some indication that we are far from defeating the virus. Just a last point to add, so far the rating agencies have been lenient and very forgiving on the increase in fiscal deficit of most countries, citing that it is temporary. But if indeed the recovery timeline is extended, we are likely to see more downgrades of corporates and even country ratings. We think that market is likely to remain volatile with an uneven recovery scenario, and it is important to conduct proper market and credit analysis to pick the good credit and avoid any potential landmine in generating long-term appreciation and capital preservation. So with that, I'll hand it over to Sarah and the panelists. Thank you.
Yes, thank you, Lang Chun, for that market overview. So we'll now go on to our panel discussion that we have for you. So first off, maybe let's start off with a brief rundown on the markets that you cover. Investors had a choppy ride in the first half of 2020. Could you share with us how the markets that you are covering been performing and relative to other comparable markets? So maybe we'll start off with Edward.
Sure, thank you. Hi everyone, I'm Edward. I look at Asia local currency bond strategy in Nikko. So this strategy has two parts that drive performance. The first part is the return of Asia currency, and the second part is the returns of Asia local government bonds. To gauge these strategies' performance in this pandemic crisis year, we look at the year-to-date returns of a representative benchmark like the Market iBox LB. So this benchmark actually recorded a positive 1.4% total return year-to-date ending June. And if we break down the returns, the main contributor to the positive returns is actually from Asia local bonds, which gained 4.3%, which is then partially offset by currency depreciation of 1.9%. So what has been driving the rally in Asia local bonds this year? One key reason is that the macro backdrop, which we are in now, is actually quite conducive for government bonds. To start off, we are in a low inflation environment. Then on the growth front, due to the pandemic situation, most Asia countries are actually coping with a recession, which means that the growth backdrop is very weak. And remember, in a slow growth and slow inflation environment, government bonds tend to do well. Another reason why Asia local bonds has done well is because of aggressive monetary easing in the region. Basically, central banks across Asia are cutting their interest rates. In addition, there are a few central banks that have introduced some sort of bonds buying program to keep the rates low. So all these aggressive monetary easing leads to lower interest rate and support Asia local bonds. On another hand, on the currency front, so Asia currency had a choppy first half of the year due to weak risk sentiments, but since then risk sentiments has improved and Asia currency had seen some rebound. As Lang Chun pointed out earlier, there's still quite a fair bit of uncertainty ahead, so we will expect the recovery of Asia currencies to be accompanied by occasional bouts of volatility. But that said, let us also take a look at how the entire Asia local bonds market had performed through this crisis relative to other parts of the emerging markets, such as Latin America, Central and Eastern Europe, and the Middle East. So if you refer to my slide, which shows showing 1-year risk-adjusted returns of different emerging market regions, you can see that actually Asia had outperformed other parts of emerging markets over the past few years. That's because Asia has stronger fundamentals, improved credibility of policies, better political stability, and less volatile currency compared to other EM regions. For example, other EM countries like Brazil, Turkey, South Africa, and Argentina have much more volatile markets to deal with, whereas Asia currencies are in a better shape than them. Thank you.
Thanks, Edward. So now we'll go on to Yihui.
Thanks, Edward. Hi, everybody. I'm Yihui, and I manage the China onshore portfolios. So for China, in the near term, the China bond market has actually done a V-shaped type of a move. So in the first quarter, when the coronavirus was actually very rampant, we saw that bond yields were rallying quite strongly. And then after that, as measures kicked in and there were fiscal measures as well as monetary measures, the growth picked up and credit has turned around. And this morning, we just saw again strong growth numbers from China. So it does show that recovery is in process. So in the second quarter, due to this and a lot of the fiscal measures and monetary measures that they have done, bond yields have also risen in tandem. So now, how has the performance been versus other markets? And we think that in this environment, it does seem that China looks very volatile. But actually, when we compare China fixed income returns with the returns in the G3 markets, we see that over the longer term, actually on a risk-adjusted basis, China bonds actually provide a higher risk-adjusted return than the other markets. There is also an investor perspective shift going on in the markets, where we think that that China has become sort of a safe haven, where China policymakers can conduct monetary policy independently of what is going on externally. And we have seen this last year, where US growth was actually still okay, but China was suffering from some of the effects of the trade war, but they were able to continue to ease. So as a result, I think because of this investor shift, we do see that risk-adjusted returns in China over the longer term does outpace that of the rest of the G3 markets. And this is important because in this environment where there's a lot of negative yielding debt and unconventional monetary policies, China is still able to conduct conventional monetary policy. And therefore, this actually helps in terms of structuring of portfolios. And this will help in controlling the volatility of returns as well. So from asset allocation perspective, this is an asset class that you should look at to add to your portfolio.
All right, thank you, Yihui. Now we'll hear from Xiaofang.
Hi, thanks for arranging the call, and welcome everybody to our view on Asian markets. I focus mainly on Singapore strategies. This includes Sing dollar strategies as well as fixed income strategies that hedge back into Singapore dollar. My focus is split between rates as well as credits, and we are quite adept at moving risk around between these two markets. Just for a top-down introduction into the relative performance of Singapore dollar in the last 3 months, especially, you can see that since the year end, Singapore government securities have rallied quite hard. And this is very much in line with the wider developed market bonds as well. You can see we are very much in line with US Treasuries, and Treasury yields have rallied because of Fed intervention in the markets, both from a rate perspective as well as from an unorthodox QE perspective. So with the yield curve very much lower than at the start of the year, government bonds have definitely outperformed, at least from a AAA perspective. The Eurozone has had its problems ongoing, and they had a negative yield curve across most of the front end, and they continue to have a negative yield curve now, even more so after COVID has hit. So where does that leave us? The AAA universe is quite small to begin with. Singapore has 3 unsolicited AAA ratings from the major rating agencies. It's one of the few countries in the world to retain this. This has come into focus recently because Canada has been downgraded from AAA to AA plus by Fitch. So in terms of all rating agencies giving us AAA ratings, there are only a few more countries left in the world. Germany is the biggest. The rest are pretty small and medium. So Singapore, being a small country with a smaller debt market relative to other countries, still benefits from some of the flows from investors seeking very, very high rated AAA ratings. And so because of our small market, relatively speaking, we should see a little bit of a boost from investors seeking yield. And when I say yield, the important yield number to note here is really the 10-year yields, and also the real yields. So yields are meant to compensate for inflation. So we adjust the 10-year yields for inflation, and what do we get? As of the year end, US was leading the way, even though it's a AA country. Most people treat it as AAA across, at the safest asset in the world so far. They were yielding about 1.7% on an inflation-adjusted basis. This meant they far and away outstripped all major economies in terms of giving investors an inflation-adjusted return that was quite superior, even Singapore. Now come COVID, you see all the curves have collapsed. Sing curve used to price below the US curve, now it's pricing more or less in line, slightly above. But also importantly, inflation has dropped off to pretty much negative levels, especially for Singapore. In the US, they dipped in April and May, and now they're back up to maybe mildly positive. Where does this leave real yields? Real yields in Singapore now look really attractive compared to all the other countries. I think the one that is most surprising is probably the Australia Commonwealth government bonds. They used to be offering pretty much flat real yields in the 10-year space, but they've now dipped to quite a negative level because a lot of investors have been chasing safe assets. So Aussie dollar safe assets have also been chased along with US dollar, euros, and Japanese yen. So right now, from a relative basis, we still see Sing government bonds offering quite a good real yield. I think in addition, we'd also like to mention in the credit space, the Sing dollar market is quite undersupplied for this year. We've had a lot of issuance in US dollar space in Asia, so offshore US dollar, but Sing dollar has been quite undersupplied with new issues. Most issuers have stayed back and not issued Singapore dollar bonds. And that leaves quite a lot of technical pressure within the space, which I will get into more in the next few sections. I think our outlook for Sing dollar is quite stable. MAS has reiterated very often that they are looking for FX policy stability. So the Sing dollar near the trade-weighted basket of currencies has been very stable. I think this has sort of taken FX out of the equation when it comes to comparing different rates, and we should expect to see, at least in the medium term, Sing dollar price very close to the treasury curve. So instead of taking an outright directional move, a large directional move, we're taking a view of being more tactical and being more nimble. This is probably where active management comes to the fore in terms of duration management, and also bottom-up security selection. I think, summing all this up, we also see that, with combined research with Edward's team, Yihui's strategies, and so on, as well as credit strategies, what we really want to do is try and find the best risk-return opportunities. And some of these can be found in local markets, some of these can be found in local credit markets as well. And so our focus for the Shenton Income Fund is to try and mix all these up and create a very steady return target of 4%. And this is the income generation focus that we have in order to maintain the dividend flows. So that's our relative view of markets for Singapore.
Thank you, Xiaofang. So our next question is, what are some of the market tailwinds investors can look out for? And how will this shape up for your fund strategies moving ahead? So we'll go to Edward first.
Thank you. So after a hectic first half of 2020, the key theme going forward, in my view, that will support Asia local bond strategy is the massive liquidity injection from the major central banks such as US Fed and Europe's ECB. So after seeing US Fed cutting their rates to near zero, the Fed had also embarked on yet another massive bond buying program that could expand their balance sheet by estimated 6 trillion from March this year till the end of 2021. And if you refer to my chart, you can see that whenever major central bank does a QE bazooka, portfolio flows into Asia tend to increase, but with a lag. We are probably maneuvering in this lag now, where risk sentiment is trying to find a firmer footing. So when major central bank cut rates to zero or negative, inject massive liquidity, and promise to keep monetary policy accommodative for a long time, this pool of liquidity will eventually try to find its way to better yielding assets, or what we call the hunt for carry. So Asia is one such potential destination. Ever since the large outflows from Asia in March, we have only started to see some small inflows recently, and the size of the inflows is not as big as compared to the magnitude that had withdrawn from Asia. So this means two things. First, positioning is still light in Asia. Second, investors are not yet fully convinced of this recovery. So this is understandable, given that this is a global pandemic situation. The plunge in global growth is severe and will take time to recover. And all these reports of rising cases in US is definitely not helping. But the silver lining here is that as Asia economies reopen, we have started to see some recovery in Asia PMIs, which is the manufacturing numbers, which could show a signal that growth is starting to bottom out in Asia. So in addition, unlike the central banks in developed markets, Asia central banks had not reached their lower boundaries in terms of policy rates. So there are still room for Asia central bank to ease monetary policy in future if there is a further need to support their economies. More importantly, as compared with other parts of the world, Asia fundamentals was strong entering this crisis. Ever since the Asia financial crisis, Asia economies had been actively building up strong fundamentals over the past few decades. So Asia is in a better shape now to deal with this crisis. So to sum it all up, while we may continue to see some short-term volatility, the broader theme of flush global liquidity injections remain favorable for Asia local bonds, where positioning is still light and fundamentals is still relatively strong. Moreover, Asia currency has yet to fully recover from their depreciation early in the year, and there's still room for appreciation when risk sentiment improve. Thank you.
Thanks, Edward. So now we'll go to Yihui.
Yeah, so for China, there are 3 tailwinds, and some of these are structural in nature. So the first one for China's bond market. So China's bond market is big and it's still growing. And this provides vast opportunities for investors who are looking for both yield and capital pickup and capital appreciation, basically. Now, last year, China overtook Japan as the second largest bond market in the world. And why do we expect it to continue to grow? This is because of the policy direction. So the policy is supporting the market, and they want more avenues or different sources of funding for their corporates. And so therefore, the bond and equity markets basically are the markets that they want to develop going forward instead of just bank lending. So historically, that has been the case. Banks have been the first choice for corporates in terms of getting funding. But now this is changing, and it provides price transparency for the corporates. They can see what kind of rates they're getting, and this is a much bigger avenue for corporates to fund themselves. So that's one structural theme that we can see that will continue for the next 5 years. China's bond market is growing, and there are many opportunities and different products that are developing onshore, providing both yield pickup as well as capital appreciation. Now, secondly, with such a big market, of course, policymakers will make it easier to access the market. And on this front, we have seen the access routes getting a lot easier and more simplified. So it used to take 1 year to open an account for an institutional investor. Now it takes 1 to 2 months. It used to be that you couldn't hedge the currency with instruments onshore, but now you can because they have opened up avenues for you to do so. And lastly, on taxes, they have been very proactive in taking investor feedback. And so last time there used to be withholding taxes on foreign investors, but now foreign investors need not pay any withholding tax. And we do expect that more measures that are supportive of accessing the market, of developing the market, will continue. So this puts us in a good state. And we have seen also structurally inflows having increased on the next slide. So in terms of inflows, there are two factors to this. One is, of course, the bond market that is easier to access now, that's attracting investors. But secondly, and more importantly, there has been index inclusion on China. So last year, we saw that Bloomberg Barclays index included China into the index, and this resulted in inflows. And this inclusion is still ongoing because they are phasing it in for 21 months. And then we saw JP Morgan index, they included China this year, and it is also still ongoing. The next big index that could potentially include China is the FTSE index. They have a review coming up sometime in September, October, and we do expect that there will be a potential for positive surprise. So if the three indices with this inclusion, there will be both passive and active investors who want to get involved in the market. And this is a positive spiral because when you get more familiar with the market, you will expand in the product scope. There will be more inflows because more and more investors get familiar with this market. So with this index inclusion, there also is a shift in investor perspective. So whereas previously when the RMB depreciated, you could see outflows or lack of inflows or slowing down inflows. But now as the currency depreciates, even with depreciation, investors can see that PBOC is able to manage the currency effectively. And so therefore they see this as a better entry point rather than anything very scary. And so I think there has been this fundamental shift which bodes well for inflows in the next 5 years. And so therefore these are the three tailwinds that will benefit this market. And in terms of our strategy, it also benefits our strategy because we are invested onshore in both rates bonds, government bonds, as well as on the credit side. So we will be able to capture more opportunities as liquidity improves and there are more products available. So that's it from me.
Thanks, Yihui. Now we'll go to Xiaofang.
Thank you. I guess this is what excites investors when we're talking about tailwinds. The market that we addressed for the flagship fund is in Shenton Income Fund is the Singapore and Asia credit space mainly. This is what we're familiar with. This is what our analysts cover. So I'll speak to those markets generally first. I think from all the presenters, you would know that technical factors are a favorable tailwind for all assets generally in the world, and the policy backstop does have a trickle down effect into Asia, including Singapore, even though there is no direct stimulus. So one key thing that we look for when we look at technical factors is supply. In comparison to other years, especially last year being the most recent, we can see that while Asia IG supply, investment grade supply, has been quite strong, and spreads haven't been unduly moved from their moving averages. In Sing dollar, IG issuance has been very, very suppressed. The deals that have come out have all done very well after issuance. And we'd also point out that some of the deals are private and maybe not captured by our statistics. And they basically have a ring-fenced investment sort of investor base. These are mostly the Temasek main companies. So for investors out there like us and you, the ability to access new issues and sort of recalibrate the portfolios and relook at risk is kind of limited in the first half. We expect to see a bigger improvement in the second half, and it has picked up, but it doesn't look like it's going to keep up with 2019 run rate. What that means is that with bonds continuing to mature in good order, there is a lot of cash sitting around waiting to be redeployed. And the problem is that there is no new home for these maturities. Some of it has to be, I guess, saved or paid off, used to pay off other liabilities. But there is a significant amount of money that is not subject to financial stress for the investor, and therefore is waiting to be deployed. So we think that the technical pressure on Sing dollar space is very, very strong. The other thing within that sort of context that we look for is Sing dollar market is not standalone. There are issuers here that issue in other currencies and other structures as well, different types of bond structures. We are able to look for dislocations in individual bonds and individual issuer curves to try and pick up alpha opportunities. And this is also, I mean, technical pressure is part of it, and it also helps us to look for alpha opportunities in that respect. From a more macro perspective, I think reopening is a key tailwind for the Sing dollars credit space, especially and generally the economy, because the Sing economy is very much finance and property heavy. So any kind of reopening progress or momentum will definitely have a big push for a lot of the credits in our space. We haven't quite looked at property as being fully recovered yet. And I think you can see that from the second chart on the right, credit spreads have indeed recovered from the widest point reached in March and April, but they are still sort of near a long-term mean rather than where we were in the last few years, which was a much lower level. So we didn't quite touch the limit of the first standard deviation, but we're definitely back down to our historical mean. So valuations are very fair at the moment. If something like a SARS-CoV-2 vaccine comes up, that will be a game changer, and that will push the spreads lower again. We're not sort of pricing that in at the moment. It's something to look for in the future, but that could be a key tailwind. Just like Leung Chun's slide at the start, we're definitely looking at stats like Google Mobility to track how fast the reopening is going. The other positive risks that could come, and this is really an outside risk, is if MAS takes a cue from global central banks like the BOJ, ECB, and the Fed, and starts to support the local currency bond market directly, or even the equity market. Thus far, MAS has shied away from direct asset purchases because I think they are quite non-interventionist in capital markets. But we've seen even regional central banks such as Bank of Thailand, the Australian Central Bank, and the Bank of Korea as well, start to actually buy securities directly from the market. And this is something that has never been done before on such a large scale. And this is seen as a very big boost to local assets. So if MAS comes out to announce any kind of support, this is an outside risk that could basically drive the whole market lower in terms of yield, and therefore it will give us quite a lot of capital gains. It's not a base case, but we try to watch out for things like that as well. I think to sum up, we're happy to look at higher carried returns. Spreads are much wider than the last 2 years, so returns from carry and coupon income should be quite good. But as I mentioned, within the space, we look for dislocations across different markets and different issuers. We are also on the hunt for tactical opportunities. Yeah, that's it from me. Thank you.
Thank you, Xiaofang. So what are some of the headwinds that investors in your strategy should be cautious of? And how will such risk potentially affect your fixed income space? For Edward first.
Sure. So one of the headwinds I'm monitoring in my space is the aftermath of fiscal expansion in Asia. So as Liang Chun earlier pointed out, besides aggressive monetary easing, Asia authorities had launched huge fiscal stimulus to lift their economies out of this crisis. For example, countries like Singapore, Malaysia had introduced fiscal stimulus of almost 20% of GDP. This scale is huge and unprecedented, and it's observed that the total Asia fiscal stimulus launched during this crisis is already larger than what was launched during the US financial crisis. This is reasonable given the severity of this crisis and is in line with what every other countries are doing in other parts of the world. But fiscal stimulus doesn't come free. There's two consequences to watch. Number one, debt levels will increase. Number two, bond supply will increase. So let me address this one by one. First, the total debt of Asia economies is expected to increase after this crisis. According to IMF forecasts, Asia debt to GDP may increase from 54% to 65% from 2019 to 2020. This has also prompted rating agencies to sound warning to a few Asia countries by putting their rating outlook on negative. But if we put these forecasted debt levels of Asia into perspective, the debt to GDP of G20 economies is forecasted to rise from 94% to 111%, and debt to GDP of Latin America to rise from 61% to 82%. So Asia debt levels is not overly high to start with, which is a reiteration of what I've mentioned earlier, that Asia is entering this crisis with relatively strong fundamentals. So what's important in the next 1-2 years is for Asia government to show that they will revert back to fiscal discipline and show effort to bring down their fiscal deficit. Next, on the supply front. So almost all Asia countries are expected to increase bond supply to finance their deficit. To elaborate on the implication, when bond supply is high, you need demand to be high as well to maintain the bond price stability. Overall, the increase in bond supply in most countries are still manageable and have already more or less been priced in. And as mentioned earlier, some Asia central banks have also started their own bonds buying program to support their bond prices, and we are not overly concerned at this point. Lastly, all the above points also leads to a reason why we prefer shorter dated bonds as compared to the longer dated bonds, as we expect Asia yield curve to see some steepening. Thank you.
Thanks, Edward. Next, we'll go to Yihui.
There are two headwinds in China that you have to be cautious of. Number one, this pertains to the domestic economy, where because of the COVID-19, we have seen and many measures that we have seen, but in terms of the SMEs and employment situation, there are still pockets where SMEs are not able to get equal access to funding. So a lot of the funding can be accessed by the big SOEs, but we know that because of the spread of the COVID-19 and as well as the huge SME spend, where there are many types of different SMEs, the access to funding can be curtailed. So in this sense, we do expect that defaults onshore will start to slowly pick up. And what is holding it back now is because of all these measures. And once these measures, in terms of rolling over debt or deferring interest payments, are over, then we could see some of these defaults come through. Of course, as growth recovers, there will be slowly, alleviation of some of this impact, but we will continue to see credit defaults. As such, I think in terms of investing onshore, we continue to keep to the investment grade type of credits, as well as some of the larger SOEs, because we think that this has a lesser risk. And of course, we will see with defaults spread widening in such areas. As due to the measures, the spreads have actually narrowed, so we're actually cautious in terms in the high yield space onshore. The second risk that we see will come from geopolitics. And we see that, and I think that geopolitics is something that will continue on for a while. And we have seen that in the trade war, we have seen that in the tech war, we have seen that in Hong Kong, Taiwan, and sometimes North Korea comes up as well. And because China is closely linked to North Korea, this also becomes a risk for China, investing into China. So how will this impact the portfolio? Well, while such risk events is actually good for fixed income, it essentially will impact total return through the currency. So we have seen the depreciation of the RMB during the trade war, and some volatility that comes in the past couple of weeks, where China passed the Hong Kong security law. And we did have one question, and I will just put it up front here since we're talking about the same headwind in terms of geopolitics. And this question is on dollar settlement. And we think that number one, it is a very low probability that happens, mainly because, and we've seen that the US did not even implement this in the Hong Kong dollar space, so much less on China. Number one, it will affect the whole market, including US companies themselves, and because the global economy is still very closely linked. So this will have a very, very huge ripple through effect and will cause a very big of difficult to envision such a policy step, and they did pull back from that in terms of the Hong Kong dollar. Now, secondly, and more fundamentally, the dollar is seen as a reserve currency, and the convertibility has, there's no question about its convertibility. Now, if you were to implement such a measure, this convertibility and its status as a reserve currency will come into question. And this is not something that they will actually want to fiddle with at this point in time. Now, there is a potential for them to implement it perhaps sporadically or on individual companies. But that can be mitigated in part if the company is, for example, an SOE, which is linked to the government, or if we are investing in companies that are more domestically driven. So on that front, these are some of the mitigating measures that can be in place should they come down on specific companies. Thank you.
Thanks, Yi-Hui. Now we'll address this question to Xiaofang.
Thanks. I think the headwinds for the Sing space and Asia credit space generally are more or less diametrically opposed to the previous question in terms of looking at tailwinds. So I will go through some of these sort of opposite scenarios. The one thing that is on top of everybody's mind at the moment is clearly the size and consequence of subsequent COVID waves. We see some US states declaring a second wave. Hong Kong is going through a third wave, and all countries are trying to sort of manage the infection rate as well as the hospital admission rate quite aggressively. This obviously poses a risk for the V-shaped recovery scenario, which seems to be starting to peter out already if you look at some high-frequency data in the US. So states that have opened too quickly have had to reshuffle and shut down the reopening for the time being. And that definitely has a very strong effect on expectations of future growth, especially for third and fourth quarter. Related to that, secondly, we would look at possible breakdown in policy, global health policy coordination. This is perhaps in line with US-China tension, but specific to COVID, I think the WHO has not been perhaps been able to do the best job in coordinating global health policy. And now with the sort of breakdown and fragmentation of different blocks and different countries' policies, that it might lead to multi-year travel and other restrictions. So this impact on travel, leisure, and also retail is going to be felt more deeply and for longer. That is a huge risk in terms of the outlook. Thirdly, more broadly, geopolitical tensions outside of COVID, as Yihui has alluded to as well, may come back to haunt the markets. I think the November election timetable in the US is quite important, and to see what potentially could result from the already fairly unstable policy making apparatus in Washington. So if there are sort of market unfriendly or EM unfriendly policies that come out in the run-up to November, that would definitely have an effect on a negative effect on our markets. There is a Fed backstop at the moment, so that should provide a little bit of relief, but we are not immune. And the one scenario that it's most risk off is if something like March scenario happens again. The Fed backstop can help, but it really was something to be noted that the market move in early March was a strong rally into sort of less risky assets, including Sing dollar, which is a relative safe haven within Asia. But when the market moved to its absolute low, then the risk aversion reached a maximum, and only global safe havens benefited. So you saw money flow out of Sing dollar into US dollar, Japanese yen, Swiss franc, and maybe some pounds. This kind of maximum risk is not a base case scenario, but it does show us that if risk aversion reaches a peak, you really do need to be very wary of where our exposures are. That's it from me. Thank you.
Thank you, Xiaofang. So lastly, could you highlight two main reasons why investors should consider investing in your fund strategy and given current market conditions?
Yeah, I will start it off. Thank you for the question. One reason why investors should consider investing in Asia Local Bond Strategy or our Nikko AM Shenton Asia Bond Fund is that Asia Local Bonds still offer good quality and attractive yields. Going forward, we expect developed markets to maintain their easy monetary stance for quite some time. So this means that interest rates in developed market will remain low or negative for quite some time. As previously mentioned, excess liquidity out there will eventually try to seek better yielding markets when market sentiments improve to earn a better carry. And as seen from the slide, Asia local bonds still provide decent yield pickup over developed markets after adjusting for inflation. And these are good credit quality yields. All the Asia government bonds that we cover and invest in this strategy are currently all of investment grade sovereign rating. The overall average credit rating of Nikko Shenton Asia Bond Fund is A. And year to date, the fund had returned 4.7% in Sing dollar terms as of June. Another reason why you should invest in Asia local bonds is that your risk is well diversified across 9 countries, which is important in an uncertain environment. So this strategy will be suitable for investors who are uncomfortable in investing in single country fund and prefer to seek a more diversified strategy. So Asia has a wide and diverse spectrum of countries with different characteristics. You have Malaysia and Indonesia, which are more sensitive to commodities. You have more advanced economies like Korea and Singapore, which are more sensitive to global trades. You also have high-yielding countries like India, you have tourism countries like Thailand, and you also have defensive market like Philippines. So you have a huge spectrum of countries to choose from depending on the market environment. In addition, the fund invests mostly in government bonds, which are typically less risky than corporate bonds. So this fund again suit investors who are slightly risk averse but still will want to have a respectable yield. Thank you.
Thanks, Edward. We'll now go to Yihui.
So from my perspective, I think the China bond market, as I earlier mentioned, in terms of the tailwind, there are the structural tailwinds that we should be very conscious of, and we do want to have the first mover advantage. And given that we have been pretty long in the China onshore bond market and have experience there, we think that this is the right time and opportunity for investors to jump in to participate. So the structural factor of the growing market as well as the policy direction will be with us for the next 5 years. As well, China continues to carry out conventional monetary policy. So as growth steps down gradually, we can be sure that the interest rates will continue to go on a downward trend. So this is a longer term trend that bears watching as well, given that China's leverage is actually pretty high. It is very difficult for interest rates to rise by too significant amount. So therefore, the longer term trend will continue to exert itself. Now, in terms of our fund distributes, has historically distributed a dividend of around 4% per annum, and we expect that to continue. And that will be attractive for an investor who wants a stable source of return. As well, our fund is flexible, so our mandate actually enables us to invest a small portion of it into non-RMB assets, meaning issued by Chinese issuers offshore. So, for example, dollar credit or SIM credit issued by Chinese issuers, for example, and we can hedge it back into RMB. But these are all Chinese issuers, and as the offshore market has been growing and access between these two markets has been also growing, has become easier, it is prudent to actually decide where to allocate your assets in terms of where the next return is going to be. So onshore, for example, in the second quarter, had sort of yields rising because credit and growth measures were supporting it. And so therefore, it would have been prudent to have actually shifted some of our assets offshore to invest into CNH assets, to invest into Chinese issuers in dollar bonds, for example, where there was return to be picked up. And so therefore, the fund gives you that flexibility. And so therefore, I think in terms of looking at the market, the China bond market, you should start looking at the bond market as a whole and not just onshore, offshore separately. And that will give you the extra alpha that investors are looking for.
Thanks, Yihui. Now we'll go to Xiaofang.
Thank you. I guess to sum up the two main reasons for investing in the Shenton Income Fund, I will also talk about flexibility. The main thing in volatile markets is to have a flexible strategy that can fairly nimbly navigate between different risk narratives. The slowdown that we've seen from COVID and the sell-off that we've seen from COVID and the subsequent recovery has been one of the fastest and largest market moves in history. It's comparable to the 1933 market move. This really shouldn't be happening in a modern marketplace. So a lot of models that have been traditionally used have sort of failed because of the speed of the move. What is very clear for us is that we are very focused on the 4% return target and the income generation objective of this fund. So we are taking this flexible strategy in volatile markets to look at both rates and credits and allow us to search for the best bottom-up ideas from each market. So that's the first advantage. The second advantage that we have is right now, there is quite a huge fiscal and policy backstop that's been in place across all countries. This is quite unprecedented in size as well as reach across all countries. This means that we are definitely going to be in a better place than the GFC from a policy perspective. But the outlook is still very uncertain as to how people are going to get back to work and start consuming again. This is uneven, but our base case is that the economy will recover. In such instances, maybe the pace of past recoveries may not be a good guide for us. So we're really focusing on what is a good transition asset class, where you are going between growth and defensiveness. And that to us is in either local currencies or in credits. So the flexible strategy from the fund, we can really catch the early but uneven economic recovery by focusing on a transition asset class, which is credits. The returns that we get are likely to be split between carry as well as spread contraction. As long as governments keep focused on reform and keep focused on trying to recover from the damage, this asset class should see quite decent, stable returns as compared to maybe other volatile asset classes. So there is a need and a very good reason to put fixed income and income generating funds into a diversified portfolio. And we stand by to sort of serve that need during volatile markets.
All right, thanks Xiaofang, and thanks once again to the various panelists, Edward, Yihui, and Xiaofang, as well as Langchun earlier for the market overview. And now we'll end off this webinar. Stay safe and take care.